How would you like to learn how to buy a property on auction? You know, the kind of property where you're getting 30, 40, 50% below market value, where you're buying a gem in the rough. Well, then this course is for you. During this program, I'm going to take you through all the various steps that you need to take in order to make a good informed decision. We're going to look at various different property investment strategies like industrial, commercial, and residential. We're going to look at how to find the right area where the yield is strong, where the risk and reward balance makes sense. I'll show you how to analyze deals using this one right behind you. This was one of the deals I bought on auction. I'm going to take you through a live case study, how I analyzed it, and how I was able to bid successfully. You're going to see all of that and more, the behind the scenes of how the sausage is made. I'll also share with you how to get your finance together, how to do the legals and the transfer, and finally, how to manage this asset so that it gets the return that you hope it does. This course is not for the faint at heart, but it's for those who are ready to take that bold step. Auctions, they're fast, they're final, and they're unforgiving. But if you're knowledgeable, if you know what you're doing, they're a gold mine where you can buy properties at a fraction of the price and get a great return on investment. Before you even start looking on Property 24 for the right deal, you have to figure out your strategy. There are three key things you have to look at: your archetype, your resources, and your goal. Now, are you the archetype like I am, the accumulator, looking for high-yielding cash flow properties that is just going to accumulate and accumulate because then the affordable housing section makes sense? Are you more of a creator or curator? You want to be in the more affluent zone where you're doing your Airbnbs. Figuring out your strategy is key before you start scrolling on Property 24 and looking for deals. Your strategy defines your area. So if your strategy is something like student housing, you need to then go and find the area where student housing is applicable. And student housing works wherever the demand for student housing is strongest. So you want to be within a 2 to 5 kilometer radius of a university with access to a gymmy or some sort of public transport service. Then you want to make sure that the property also makes sense for your strategy. So students want Wi-Fi, they want security, they want access to nightlife. So once you know your strategy, your starting point, then you can find the area where you're looking for. And then when you're in your area, you start looking for deals like this one behind me. Now, residential is usually a good starting strategy for most investors. This is where you're buying and renting out to a tenant, to a family or to a couple. This is a great strategy because it's low risk, there's tons of demand, and it's really easy to get into the game. The purchase price is not as high. Industrial, like the one behind me, is more of an advanced strategy. This is where you're renting out per square meter and you're renting to an industrial client. So maybe somebody that owns a workshop or that is doing some sort of factory work, they would probably rent this kind of property. Now, the returns here can be very lucrative and your lease agreements tend to be much longer. You'll look at 3, 5, maybe even 10-year leases. The challenge with industrial is once the property is empty, once the tenant leaves, finding a new tenant and signing a new lease agreement can be a bit challenging. So residential has got its pros and cons. It's easy to get into, your demand is high, your returns maybe on the con side is not that exciting. On your industrial side, your pros are you have long lease agreements and you have good escalations. The downside is you might not have as much demand and you might sit with an empty property for 6 or 12 months, where in the residential space, there's tons of demand. If you look at commercial follows the economic activity, right? So during the good times when businesses are doing well, occupancy goes up, escalations go up. The downside of commercial, and we saw this with COVID, we've seen this with work from home, sometimes your demand falters. And again, if you don't have a paying tenant, you're sitting with an empty unit, your cash flow is going to suffer. Then you've got other strategies like student housing, which is a really exciting and very lucrative strategy, but it also comes with its own risks. On the positive side of student housing, demand is good, return potential is fantastic. On the downside, heavy to manage, your vacancies are high, and then if you're dealing with NSFAS, which is the government organization that funds low-income students, you know, your cash flow suffers because they don't pay you every single month, and sometimes they take 3 or 4 months to pay you. So what I'm trying to say here is that choosing your type of investment strategy is a personal decision, and there's many different ways to skin a cat. I decided to start with the residential side because it was a low barrier to entry. It got me into the game, and now I'm moving into the space where there are more commercial and industrial type properties because I'm willing to take the higher risk in exchange for the higher return. So make sure that your strategy meets your resources, your goals, and your risk appetite. There isn't just a best strategy. There's a best strategy that suits you. Now, my strategy is the BRRRR strategy. That is to buy a distressed property, renovate, get it rented out, performing well, and then refinance to pull equity out of the deal. The reason I like this strategy is because you can buy a building at a much lower valuation. So a building that's maybe worth 3 million, you can buy at 2 million because of the distressed nature of the building. So it could be that the tenants are not paying, the landlord is unable to manage, the landlord is relocating or is in financial distress. There's many reasons why a asset would be considered as distressed, but a distressed asset, that is where you can get the big discount. Now, this building behind me was exactly that, but it wasn't a distressed building per se, it was a distressed seller. The reality is that this person was going through some health difficulties and needed to sell quickly. They put it onto the market at about 3 million rand, which I think is a fair valuation, but they weren't getting the leads that they wanted and they weren't going to sell it in the time frame that they had. Their time frame was really short. With that level of motivation, we were able to get a 2 million rand offer across the line, 2 million rand for 9 two-bedroom units. It's a fantastic deal. But the caveat was we had to do a cash purchase. They were not willing to entertain a 2 million rand offer subject to finance. So I went to private finance through my YouTube channels, and I was able to raise the money through selling shares and selling equity in the company. And then what we did about 12 months later, once we had revenue, we had a case study, we could see how much rent was coming in, we went back to the bank and refinanced, which basically means we pulled out that equity. Now, we weren't able to pull out all of our equity. We put about 2 million rand in and we pulled out about 1.5 from the bank. But that 1.5 we could use into the next deal, buy the next acquisition, and that's how we were able to recycle that initial investment and scale our portfolio. Now, each deal is different. Some properties that I buy are in a hijacked state with tons and tons and tons of repairs, and you're able to get a really cheeky discount across the line because of the distressed nature of the property. This one didn't have those issues. In fact, this property was operating really well, needed minor repairs, tenants were paying well and in a good state, so nothing really needed to change. The only thing we needed to do was put cash on the table to incentivize the owner. My goal is to have a stable annuity income, a building that generates a positive cash flow and covers all of expenses, leaving me with a monthly profit. That's why I choose this strategy, and that's why I love this market. So today we're going to do a quick educational of how you can go about doing a viewing and asking some questions on an auction property. I've got Ethan here today.
Guys.
He is a agent for Ocor, and he's been kind enough to come and let the cameras in. So Ethan, maybe just a quick intro of who you are and tell us about this deal.
So how's it, guys? I'm Ethan. I'm 21 years old. I've been at Ocor for about plus minus 9-10 months. I'm selling a property here in Windsor East on Kings Avenue. It's a neat little block of flats, 8 1.5 sectionalized units. And we're going to be selling this property on the 9th of April on auction. So basically we're selling 8 1.5 sectionalized units here. A block of flats in the beautiful Windsor East on Kings Avenue. I'm going to just give you guys a quick rundown through the property. It's doing about 420,000 Rand gross a year.
420, so that is 8 flats, 1.5, 1 vacancy.
1 vacancy, and there's 7 tenanted units.
And these rental amounts, I can see you've got between 4.6
and about 5
and 5.1. That's excluding utilities. And then electricity is prepaid, water is metered.
With meter mate.
So 1 meter or a meter per unit?
A meter per unit.
Oh yeah, so here, prepaid. Okay, that's good.
They've got quite a strict screening process for tenants.
Okay. How long has the owner had the building?
I'm actually not too sure. But he's had it for quite some time.
And did he give you a reason why he's selling?
He lives overseas.
Okay.
It's just unnecessary admin for him.
And is he self-managing?
He's doing it through a management agency.
Okay. You know the theory. Now it's time to make it practical. So we've got an access to the building. It's called Libertas. It's 6 times 1 bedrooms. What's your next question, DeCarlo?
Okay, yes, Libertas. So my question would be, how would you figure out a valuation for this sort of building?
Yeah, I mean, so when you go to auction, the seller will tell the auctioneer, this is my reserve price. And that's essentially the seller saying, I'm not going to accept anything less than that. So let's say on this building, as an example, it's 1.5. That just the seller decides. There's no real theory behind it. What we have to do as investors is try and get the price as low as possible. So technically my valuation on this should be 1 Rand or as close to 1 rand as possible. But that's not going to be realistic. So the way that I'll value the building is I'll take the basic rental, annualize that figure, and then divide it by the yield expectation. Remember that gross yield that we went through during our first coaching session?
Yes.
We take the annual rental divided by the purchase price. It gives us a percentage. And that percentage gives us an indication whether there's positive cash flow on offer or not. But you can reverse that calculation. So you can say the rental divided by the yield you want, and it will give you the valuation. So on this deal is generating 16,000 in monthly rental. So we times that by 12, and we divide that by our yield expectation. So what yield are you expecting?
20%.
20%. That gives us a valuation of 960,000 Rand based on the revenue that this property is generating.
All right, and that's the number we're aiming for.
Yeah, that would be, look, we still have to run the numbers, get the internal rate of return, factor in renovations and stuff. But in terms of when the agent gets here, I'm going to start anchoring this price with him. I'm going to say like 960 is definitely my max. So one of the key documents that you get when going to auction is this DD pack, which the agent puts together, and it gives you a bit of insight into what the property looks like. So Takala, I'm going to walk you through what this document looks like. Ask questions as you feel free. So the first thing is that this is obviously a block of 6 times 2 units. It's on Gabriel Road in Forest Hill. And here you can see some high level information. So it's 6 times 1 bedrooms, enclosed parking, which we can see there. And it's 495 square meters.
All right. At the first page, this is ERF size. What is the
Earth? So that's the size of the property, the land size.
I see.
And then you'd have an under roof, which on this deal is probably like 390. Okay. First page, disclaimer, auction information, terms, conditions, critical. Every auctioneer has a different process, but they all work sort of similar. So you have to put, first of all, you have to put a refundable deposit down just to bid. And that's just to get rid of the non-serious people. So Ocor, as an example, they charge 50 grand, which you put down. If you're unsuccessful in bid, they pay you back. But it's just to like,
all right.
It's like entrance into a nightclub, right? They want to make sure that you got some money before you walk in.
It's the ante in a poker game.
Yeah, exactly. Then if you're successful, you have to put 10% of the bid price down on the day. So if we buy this for $1 million as an example, 100,000 on the day has to be paid, plus the commission of the auctioneer, which is 10% of the purchase price plus VAT. And that is at 15%. And then they've got a confirmation period of 2 days. So what that means is if we're successful on the day at auction, we bid and we win. That's not a guarantee.
Okay, still.
The agent then takes that to the seller and says, listen, this was the highest bid we got at auction. This is what the market's saying. You've got 48 hours now to decide yes or no. So bidding successfully at auction doesn't mean, okay, done deal. If you're bidding at sheriff auction, if you're doing like a public bid, that's different. But this is a private bid. The seller still has a chance to say no.
All right. So it's all up to the seller in the end.
Yeah. The seller tends to give the agents like a reserve price. They'll say, 1 million, 2 million, whatever it is. But here's where the money is made. All right. Here is our rent roll.
Right. So what are we looking at here?
So here we've got 6 flats, 6 1-bedrooms. And we've got the basic rental. So the basic rental is working out at 16,000, and that's how we came up with our valuation.
Yes.
Using that times 12 divided by the yield expectation. But then there is a third or 7th unit here, which you rightfully saw, which was a telecoms tower. And Absa Bank Corridor Metro Tower is paying 4,500. So that's actually something we would add to our analysis. So I'm going to whip out my calculator again. So now we're not going to do 16,000, we're going to do 21,000 times 12 divided by, what was your yield expectation?
20%.
20%. That gives us a valuation range of 1.26 million. Because I'm a greedy investor, I'm going to go 25%, and that gives me a valuation of just over 1 million. And then you have to pay the deposit on the day. Where would that be? Yeah, auctioneer's commission is liable to pay 10% plus VAT on successful purchase.
We're about to go into the auction and my emotions are high, which is totally normal. Auctioneers create the environment where they stimulate your emotions. But the intent of this video is to show you the process of doing the bid. And I'm not sure if I'm going to be successful or not. The point is not to show you how to succeed. The point is to show you how to walk away when your price is not met. So hopefully by the end of this video, you're going to see this big smile on my face showing that I've successfully bid on this property that I went to go and view last week. But if it's not the case and I'm not successful, that's also okay. There's many other opportunities that will come.
Oh, let's talk business now, gents, ladies. 420,000 rands worth of income. Somebody kicked me off and say 2 million rands. I know I'm asking for a price, but somebody kicked me off. It's not where we start, but where we finish. And 2 million rands what I'm looking for. Somebody kicked me off. Where do we go from here? 2 million. At 2 million, I see him now as a 5 million. At 500,000 rand, no, we've been done now at 500,000 rand. Who's got a little bit more for me? There's been a lot of it.
No, I'll wait. I want to wait a little bit. I want to wait until that's not present.
You're putting one behind the other. At 750,000 rand, I've got your 800 now. 950. 850 I'm bid. At 850 at 1 million rand, 1.1 I'm bid now. Against the room at 1.1 million rand, 1.2 man. Should be waiting patiently. I've watched you thinking, what are you doing here for so long? But now I know. At 1.3 I'm bid to your right hand side. At 1.3 who's got 1.4? At 1.4, gents, ladies, talking now at 1.4. When you come back in at 1.4, I'm bid. I'm bid here at 1.4. It's not you, Dave. At 1.4 million rand is a no advance. At 1.4 million rand, please get my good side if you don't mind. 1.450, I'm bid. I'm bid 1.450. Will you go 1.5? 1.5, I'm bid. Thank you, man. At 1.5 million rand is a no advance. At 1.5 million rand is a too expensive for you now, man. At 1.550, I'm bid. Not for you.
Okay, it's gone over our max. Ours was at 1.5. Yep. Okay.
Okay. All right.
Cool. Thanks, Sean. Cheers, man. Yeah, this is part of the game. I'm obviously disappointed. My max was 1.5 and they got to 1.850, which I think is rich for the area. I know this area really well. I've got a building that's just behind it. And I know my price point was accurate. 1.5 for what you were getting was a fair price. I think 1.850 is not a great deal, but yeah, I'm a bit disappointed. This is part and parcel of investing, and emotions don't play a role. You have to be logical. You have to be disciplined. You have to be relentless, and you have to be able to bounce back from failure. You have to learn lessons and pick yourself back up, and chin up to the next one.
Gents, ladies, I'll tell you what, just on this income, the property's got to be worth 4 million rand. Who'll kick me off? 367,000 rand per annum of gross annual income. I'll take any offer to go at, say, 4 million now. At 4 million rand, where do we start from here? I'll take any bit to go at 4 million rand. Who'll kick me off? At 4 million, 1.5? At 1.5, I'll take. At 1.5 million rand, are we bid and done? Then at 1.5 in the room at 1.5 million rand, I'll take your 1.750. At 1.5 million rand, where do we go from here? What does your man say at 1.5? 1.7. At 1.7 I've got. At 1.7 million rand, who'll give me 1.8? Then at 1.8 million rand, are we bid and done? At 1.8 million rand? At 1.8 million rand, are we bid and done at 1.8 million rand? Where do we go from here? I'll take any advance. At 1.8 million rand, the bid is yours at 1.8. Who'll give me 1.9? At 1.9 million rand, is it no advance? At 1.9 million rand, I'll take any offer to go at 1.9 I've got. At 1.9 million rand, are we bid and done? Then the bid is yours now at 1.9. Will you go 1.950? At 2 million, he's bid. At 2 million rand, are we bid and done now? At 2 million rand, I'll let it go at 2 million rand. At 2 million rand, are we bid and done? At 2 million rand, your bid is firm at 2 million rand. At 2 million rand, is it no advance? 2.1 I've got. At 2.1 million rand, we'll let it go at 2.1 million rand then for the first time. At 2.1 million rand for the second time, is it no advance? At 2.1 million rand, the bid is with you. Will you come back at 2.2? He says no. I think the bid is yours. At 2.1 for the second time. At 2.1 million rand, third and final opportunity. Don't say I didn't warn you. At 2.1 million rand, third and final chance. Is that your bid? 2.1 million sold, subject confirm 2.1 million rand. The bid is
2.1. That is a steal, bro.
You got 3.
We got 3. We got all 3 from the same owner. That's giving us a 19% return. 19.11 at 2.1 as an offer.
Nice.
Yeah.
Well done. Buying the asset is only the first step to being a property investor. The second and more important step is how you manage this asset. If you don't look after your tenants, if you don't do proper vetting, if you don't maintain the building, if you're not proactive, you're just going to run into a situation where your tenants become delinquent, the building gets hijacked, and you turn your asset into a liability. I've seen it countless times. When you have a delinquent landlord that is dysfunctional, it breeds and spreads into your tenants. So making sure that you buy a good asset is step number one, but getting it to operate well. Having that takeover checklist, doing your proactive renovations, vetting and evicting tenants when necessary, that is where you start to get the return on investment.